this is important to realize. Skewness of an asset return is not necessarily rewarded or penalized. Just like the volatility of an individual asset return is not necessarily penalized. In terms of the CAPM, what really counts is the asset's contribution to the volatility of a well-diversified portfolio. Well, that intuition carries exactly through to skewness. What we care about is not the skewness necessarily of the individual asset return, but how that asset contributes to the skewness of the well-diversified portfolio. And the option example is perfect for this. I buy a deep out-of-the-money put, and that has an impact on the skewness of my well-diversified portfolio. It reduces the negative skewness. And something that reduces negative skewness is valuable to me. I'm going to bid up the price. So what I'm really talking about is a model that has got a CAPM standard component and an extra component, and you can think of a second beta that represents the co-skewness, or the contribution of the particular asset to the skewness of the portfolio, and then a reward for doing that, a premium. All of this together suggests that a richer model of asset pricing would surely include something that investors have preference over, and that's skewness. The empirical tests of this model are rather new. Indeed, the paper that I've written on conditional skewness and asset pricing is in the June 2000 Journal of Finance. And it's rather interesting what the results suggest. That if we run this model head-on-head against the Fama-French three-factor model, this model does just as well as the three-factor model, suggesting that the factor exposures for Fama and French's other two factors could be proxying for the co-skewness of asset returns. And perhaps the most interesting result in our paper is the set of portfolios that the three-factor model has the most trouble explaining are portfolios based upon momentum. And we think that momentum contains important information about skewness and co-skewness. And indeed, if you look at the pattern in the returns of the momentum portfolios, you see that there's a sharp relationship between momentum and co-skewness. The co-skewness model actually is able to explain the difference in expected returns across different momentum strategies. So I think that there's a lot of possibilities in the future to use these models that incorporate skewness in asset pricing. Now, the last thing that I need to say is that the model is elegant, it's intuitive, but there is one major hurdle in implementing it. And that is to figure out what the expected or conditional skewness is of the asset return. Indeed, what skewness is about is behavior, price behavior in extreme kind of movements. With the CAPM, we can estimate a beta running the stock return against the market return over the last 5 years. But it's really hard to do the same thing to estimate the co-skewness, because within the time period, we might not have these extreme observations. So you have to work a lot harder to figure out good measures of ex-ante co-skewness in the data. And I propose some methodologies to do this in the Journal of Finance paper. And it's also possible that we could use options to do something like this. But there is a hurdle, and that is the measurement. It's not as simple to measure as the CAPM. It's not as simple to measure the exposure as the Fama-French three-factor model. However, the model is rich in intuition and can be derived from theory. Seems to make sense in terms of the data, in terms of my empirical examination. And it would seem like this model does have a future.